3 top stocks to watch for December 2021. Time flies. It feels like just yesterday we were kickstarting into 2021, hoping to leave behind what was truly a tumultuous 2020. We were looking forward to an economic recovery and hoping that we would continue to move towards that right direction. It's been an action-packed year. It's been driven by a range of different macroeconomic narratives. However, we're through the majority of it, and now we're looking forward to the final month of December. Each of these 3 companies that we explore are coming into the month with different backdrops. However, each of them do look positioned to be stocks to watch over this upcoming period for different reasons. If you do enjoy this video, don't forget to hit the like button. Feel free to share it out as well. If you're new here, welcome. We make daily videos each and every day. So if you haven't yet, make sure you've subscribed. Turn your bell notifications on as well so you'll be updated every time we drop a new video, and we'd love to have you join the community. It's a fascinating collection of companies with each of the 3 playing in a different sector. We'd love to know your thoughts on it all as well. So drop in a comment below what's on your watch list for December 2021. With that, it makes sense for us to kickstart in with RAC, Race Oncology. You might be familiar with the Race Oncology story. They truly were catalysed with a significant find at the back end of last year, where they formed their new 3-pillar strategy. This discovery had to do with FTO inhibitors, a new area of cancer research that provided a lot of different opportunities. As the story goes, the City of Hope in Los Angeles scanned their entire library, searching for what could be potentially, hopefully a potent FTO inhibitor, which they believed may provide some answers about a new way to treat cancer. They scanned far and wide, and ultimately, a drug that Race Oncology had and held the rights to, called bisantrene, was found to be the most potent FTO inhibitor currently known. Of course, Race Oncology then accelerated their potential focus and moved towards this FTO inhibitor pillar. And this past year has really been about continued development, continued research, and continuing to try and progress bisantrene from the lab all the way through to the clinic. Interestingly, bisantrene does have a well-founded history. It's actually previously been approved in France, and it has gone through a range of different clinical trials, so it's been found to be safe and well-tested for humans. There's a range of different announcements over this past period that have attracted a lot of attention, but we're really going to focus on one. And that has to do with the Race Oncology Zantrene potential to actually be protective for the heart when paired with other anthracyclines. Before we do dive into this video, a reminder as well, I'm not a financial advisor. Nothing we discuss on the channel is financial advice. The stocks we cover are not buy recommendations. These stocks are not stocks to buy. Each of these are just coming into the month with an interesting backdrop. I think they'll be fascinating to watch over this coming period into December. Let us know your thoughts on it all. Drop in a comment below, and we hope you enjoy the video. And so as we discussed, after the scan from the City of Hope and the discovery that Race Oncology's bisantrene was currently the #1 FTO inhibitor available that they were aware of, Race, of course, accelerated their focus to really continue to look at this FTO pillar that they established and to assess how they could potentially position bisantrene to be a treatment in this new and up-and-coming space. We can see here Race Oncology have provided with their recent investor presentation that the estimated FTO addressable oncology market is above US $100 billion. This is a significant market. And of course, you can have a look here that for the target indications, including melanoma, renal cell cancer, and AML, which Race Oncology are exploring in their own different rights and trials at the moment, there's significant markets that they are able to explore. And so this pillar is attracting a lot of attention for ASX RAC. However, just over this past month, there was another breakthrough find, which has been potentially considered almost as big as the recent FTO inhibitor discovery at the back end of last year. And this has to do with Zantrene's potential to protect the heart. So for a bit of a backdrop, commonly used anthracyclines, which are some of the most commonly used chemotherapeutics, and so they're used very widely and broadly for many people who are experiencing and suffering from cancer around the world. Unfortunately, they are very effective at killing cancer. But what they also do potentially have is a byproduct or a side effect, which is cardiac damage. So even though individuals who have been treated for cancer may see their cancer be treated successfully, they do run the risk of having heart problems further down the line. And of course, this is not a net benefit situation. And so there's been a lot of research into what can potentially be done to surround this or how the heart could be protected. Interestingly, as we mentioned, that bisantrene or Zantrene has a clinical history already. And during those processes, they found that actually Zantrene was not cardiotoxic like many of the other commonly known chemotherapeutics. But just recently, there was an announcement and a discovery that Zantrene, it's not only non-cardiotoxic, but it actually protects from commonly used anthracyclines like doxorubicin's cardiac damage. This is a huge discovery, and of course on the back of this, there's the expectation of improved patient outcomes. There's a large existing market, potentially for synergies as you pair up the existing incumbent treatment with Xantrine, which could synergize and provide better cancer-killing treatment, but also have those heart protection qualities as well. And so with all of that, there's a real focus from Race Oncology now to pursue this cardio protection opportunity and to see where it leads them moving forward. And so Race Oncology at their recent AGM unveiled their new 3-pillar strategy. The first one is still surrounding maximizing the current Xantrine formulation. The second one is for Xantrine Optimize. They're seeking the opportunity to enhance Xantrine's utility as a compound with new formulations, potentially through IV or even oral formulation, and any potential new IP that may come out of that. And then a third pillar that they've added on now is beyond Xantrine. So RNA targeting molecules is a branch of science that's hot. It's really quite new, and it's really having a big focus from research and development, or at least early stage focus from research and development. And Roche are hoping to be a global leader in this space. And they are pursuing or considering the opportunity of internal development, partnership, and or acquisitions, which will build on the opportunity that their current incumbent treatment that they have, Xantrine, could provide. Love to know your thoughts on it all, so drop in a comment below what you think about Race Oncology and the other companies that we mentioned today, and where do you think the ASX RAC story heads from here. And so with all of that opportunity, Race Oncology unveiled an SPP or a share purchase plan. Uniquely, ASX RAC actually focused this share purchase plan all on retail investors. There was no institutional component or a capital raise on that side. It was a retail investor focused opportunity with a maximum of 30,000 as SPPs do have. And they have got this in quite a tiered stage opportunity. So it's between $19 to $29 million. It's contingent on how much support they get from the retail investor crowd. If they get the maximum investment from their investors, then they will have up to $29 million. And you can see here the proposed expenditure that they have. But there's a minimum case, there's a medium case, and then ultimately the aspirational case is for $29 billion. And you can see the opportunity that they are hoping to focus on too. This SPP closes in the middle of December. It'll be fascinating to see how it goes, the subscription levels for it, and then ultimately, obviously, how ASX RAC is able to deploy the new funds that have been raised, particularly with this new focus on the cardio protection opportunity that they have unveiled. Stock number 2 on the list, Kogan. ASX KGN was a darling of the past year. We know about the huge amount of excitement that surrounded not only Kogan, but the broader e-commerce sector throughout 2020. They were what truly was termed as a pandemic winner. As people were locked down at home, they weren't able to get to their stores. They had higher household savings because of the fiscal stimulus that was provided. People were looking to spend and deploy those funds. And Kogan, as one of the largest e-commerce companies in the nation, was one of the big beneficiaries of this. Of course, we can see from some of the numbers here with their exclusive brand numbers, there was some significant uplift in financial year 21. So what this is indicating here is at the end of the financial year through to the AGM period, which is obviously towards the back end of the year, but we can see the cycling effects coming through. There was a significant uplift in 2020, but obviously we're seeing a moderation of those trends as things get back to normal, as stores reopen again, and as we get back to a new normal, or really a life after the pandemic. But Kogan's broad offering can really be distilled down into a few different categories. First is their exclusive brand offerings. This is where they're able to provide their items that they provide at a lower cost, and they can compete on cost, but continue to provide great value to their customers. Of course, they started with their initial Kogan brand, but they're continuing to build a range of different brands up as well. And it's going to be fascinating to see how this develops. Over a 30% CAGR since the year-to-date period in FY19. If they can continue growing at this rate moving forward and developing up the brands that they have in-house, it's going to be a great growth lever for them. Then on the marketplace side, as you can see here, it's definitely starting from a lower base. It's one of their newer avenues that they're pursuing. But what's interesting about the marketplace side, other than obviously the headline grabbing 91% growth year on year for the FYs, what's interesting about the marketplace is, of course, this is where they leverage the third-party resellers, and they're a reseller marketplace like Amazon was able to successfully deploy. But obviously revenue that you're able to add in at the marketplace level is very high margin because you're incrementally adding on revenue, but essentially the cost base is staying relatively similar once you've developed the platform, other than obviously the incremental cost of upgrading the platform, the maintenance, and any of service that you have to provide as well. So the marketplace is one that they're going to continue to push. Obviously, it has the opportunity to really expand the offering for Kogan. The marketplace continues to add on different resellers, different products, and hopefully attracts more eyes to the Kogan broader platform. And this is an area that's likely to continue to be a great growth avenue moving forward from this initial lower base, of course, from FY19. However, the opportunity for total revenue to flow through from it is really quite compelling if successful. And then we know Kogan verticals as well. Kogan not only has its hand in the pie on the marketplace side, but they've got a range of different verticals. You might be familiar with their mobile or broadband plans. Maybe it's their travel or their pets or their insurance. But they really are pursuing these real large total addressable market opportunities and hoping to continue to build up that Kogan brand, continue to build up the brand affinity, the brand awareness, and continue to scale that into a truly national offering. It's going to be fascinating to see. We know that they made a mighty ape acquisition as well, which gives them exposure to New Zealand. So we'll be watching to see where ASX KGN heads from here moving forward. Why I think Kogan's quite an interesting one into this next period really is dual-sided. Firstly, I'm sure many people are familiar with the difficulties that they've had on the inventory side, and there's been a real downgrade into the terms of their share price. Kogan's lost over 50% of their share price for ASX KGN since their highs over the past year. However, with Omicron variant, discussions about the potential of new lockdowns or new restrictions, there has been more eyes on the pandemic winners and those lockdown winners. We saw Zoom share price go up after the Omicron variant was discussed. Kogan itself had a little bit of a bump in its share price too. So there's that dual-sided offering. And of course, as we get back to that new normal, all eyes will be on how e-commerce trends in Australia and around the world, and whether demand will stay elevated or will they get back to previous levels. And so building on those inventory issues, of course, we saw throughout the last financial year that Kogan outlined that they were forecasting potential demand into the future. Unfortunately, they over-forecasted and demand did not stay as high as they thought. And so as a result of that, they ended up having excess inventory. Obviously, we know that excess inventory provides a range of different issues. On the cost side, you have to pay for the storage of that inventory, so that's increased costs there. Obviously, to clear out the inventory on the retail side, inventory management is very important. And so to clear out that inventory, you sometimes have to discount that. And obviously, when you're discounting and providing stock on sale, that's going to reduce your margins there as well. And so, unfortunately, as a result of that, Kogan had some profitability pressures over this past period, which really was a catalyst for the downgrade in their share price. ASX KGN have provided updates since the initial discussion surrounding their inventory issues and have said that they have been sorting this moving forward. So it'll be fascinating to see how the market reacts to this over the next financial year as Kogan gets this under control and they start to get back to more normalized levels of demand as well moving forward. And so I think what's interesting about Kogan is just having a bit of a think about the current state of play. If we think here, Kogan's market cap, it's below the $1 billion mark. As we mentioned, they were a true darling, well above that $2 billion market cap at the peaks over the past year. However, just having a look at the price of sales here, we can see that, of course, Kogan had elevated exuberance in 2020. We know that the share price started to get away from the fundamentals. There was a lot of excitement surrounding it, trading in around that 3 price of sales level. However, it started to moderate and come back to the longer term trends now. It's getting back towards that 1 level, paying about 1.10 times sales at the moment. We can see over the longer term, that's in and around where it's traded. So I am going to be interested to see as Kogan gets back to much more reasonable valuations, particularly on a comparison basis like for like, how the market reacts as it continues to trend downwards. It wasn't long ago when Kogan was trading at above a $20 share price, but now it's well below that $10 mark. So all eyes will be on where ASX KGN heads from here. And so I think there are a few different things to consider when considering Kogan. Firstly, as discussed, they were a beneficiary of the lockdown and online demand is beginning to normalize. There was the inventory surplus, which we did discuss, which affected costs and margins. And the competitive landscape will continue to increase. We know Amazon is looking for a bigger footprint in Australia. We know other companies as well. In 2020, they didn't have their in-store retail locations. They're actually forced to invest further into their online offerings. You think about different offerings like JB Hi-Fi or Harvey Norman, Adairs. These types of companies invested heavily into their online offering. And of course, they will naturally be competitors to the Kogan offering. But I think underpinning it all, what's important to remember is the fact that e-commerce and digital sales is not going anywhere. And realistically, it's only likely to continue to grow moving forward. If we look at this visual that Kogan provided with their recent investor presentation, we can see that the Australian online retail market is growing, so there's tailwinds behind the sector, but Kogan is also growing, taking a larger market share as well. So it's a growing sector, but it's also a growing company, which is taking a bigger piece of the pie as well. So there's tailwinds behind it. I think last check, e-commerce penetration in Australia was around 10 to 15%. Of course, in nations around the world, it's as high as 15 to 20%. However, it's not inconceivable that in years to come over the next decade, we could see much higher online penetration as the market for e-commerce continues to grow and as the digital adoption picks up pace. It'll be fascinating to see which companies are the real beneficiaries and winners of it. There is an increasing competitive landscape, so it'll be fascinating to see how ASX KGN rides those tailwinds moving forward. And so on to stock number 3 on the ASX stocks to watch for December 2021, Brainchip. ASX BRN has seen significant interest in their share price over this past period. It's soared past the $1 billion market cap level. There's been a range of different formative announcements and pieces of news flow that have come to market that's really attracted a lot of ASX investor interest into the story. But to discuss why Brainchip is an interesting company to watch in December 2021, we're going to keep it real simple. We're going to keep it focused, and we're going to discuss why we can see quite a distinct transition from Brainchip as they move from an R&D focused offering into this company focused on commercialization and the next chapter in the Akida journey. Over this past period, we've done a range of different deep dives into the Brainchip story, looking at the opportunity, the technology, the team, the risks attached, and the broader BRN offering and why there's so much excitement surrounding it. If you are interested in doing deeper dives on that level, we'll leave links to those up above that you can check out after this one. But today we're going to keep it simple and focus on why we can see this distinct transition from R&D to commercialization and what it could mean for BRN not only into December 2021, but into 2022 and years up ahead. We're talking about the 4 Ps of marketing. They're commonly referred to as the marketing mix. Now, if you did a Bachelor of Business or Commerce degree at university, this might be familiar to you. From memory, I think the course code for me was MKFG 1000 for the first year course. It's going a while back, but I do remember diving into this, and I'm keen to know if anyone else did as well. So drop in a comment below if this is taking you back to yesteryear, thinking about the 4 Ps of marketing and the marketing mix. But it really is an interesting lens and framework to think about where Brainchip is, because obviously when you're in the early stages and you're developing the technology, you don't really have much of an external customer focus. In fact, Brainchip really, for all intents and purposes, have been operating in stealth mode, developing what they've needed to. There's been a real acceleration of this external focus, communication, discussion, and we'll talk about how these 4 Ps of marketing have really distilled down into their offering and what's interesting about it. And so the first of the 4 Ps is product. Now with Brainchip, we know that of course Akida, they've got their flagship AKD 1000 chips, have come off the line, the IP has been developed, and they're currently the only commercially available neuromorphic processor in the world. The testing recently has actually confirmed that there was better performance than the original engineering samples, which is a big tick. And interestingly as well, Brainchip is not resting on their laurels. They've got upcoming product releases including AKD 500 and AKD 2000, which are in development. And of course, this will help them amplify their lead ahead of the other current competitors that are trying to bring out neuromorphic processors, but of course, they haven't yet. We know that Brainchip have got almost universal use cases, particularly as the kits are delivered to prospective customers. It's going to be fascinating to see the use cases for this product, and particularly as it continues to proliferate out. The second P of the marketing mix is price. Now, I think what's interesting about price is often it's used as a point of difference. And obviously, with the commercially sensitive space that Brainchip and the Akida technology plays in, we don't have a unit economics for the price. But I think we can use price as a proxy for point of difference here. And what we can see is Akida obviously has that first-in-class and best-in-class neuromorphic processor, but they've developed a significant patent collection, which they actually recently strengthened again with a range of different announcements surrounding that. As we know, in any type of market, there really is only one best way to get from A to B. So if that best way has been patent protected, then obviously other competitors that are trying to develop similar types of solutions will have to get alternative ways to get there, which means they'll potentially have to sacrifice on performance, or they just won't be able to replicate the similar types of performances and outputs, or they'll have to use different types of inputs. And so this proxy is actually quite a big moat for Brainchip. They can't replicate that performance, and this is despite significant investment and spend. And so despite us not looking at an external consumer-focused price for this pillar of the 4 Ps, what we can reflect on is the fact that other competitors will have to spend significantly far more and potentially more time as well as capital to try and replicate the types of performance that Brainchip has with Akida. And so the third P of the marketing mix is promotion. This is quite a tangible one that we've really been able to see develop in front of investors' eyes over this past period, whether it's ADRs being announced and released onto the US markets, providing access to a broader capital pool and a broader range of investors to get that exposure to Brainchip, whether it's increased visibility through webinars, presentations, and just a general online presence on Twitter, YouTube, and a range of other social media platforms. We know that promotion is not only to do with external consumers and investors, but it's just as important promoting to customers who will be those end customers of it. Brainchip, of course, we know have ensured that their chips are TensorFlow compatible, which is a major thing. And anyone who's really familiar with the technology knows how important this is because it helps the potential developers be very comfortable with it. And also the transition from the initial CNNs to SNN networks is far easier. And we know about the EAP program as well. So both the TensorFlow compatibility as well as EAP program is really about building the market and getting a range of different potential end customers comfortable with Akida technology and really seeing Akida roll out everywhere. And this has been amplified with the recent announcement that the development kits are now available to purchase, so those can get into the hands of potential enterprises, potential partners, keen developers. They can really get familiar with what Akida is, the capabilities of it, and maybe start prototyping some ideas that may end up flowing through to IP licensing agreements in years to come. And so the fourth P of the marketing mix is place. Whether we're talking about the physical location, and it's the quadrupling of their US headquarter space with the move into the new location to facilitate sustained long-term growth in California. Whether it's the appointment of their new CEO, Sean Hare, who's got a significant Silicon Valley network. He actually sits on the board of the Silicon Valley Executive Network. And of course, he's got a long and storied history within the technology space over in the United States as well, which likely means he's got a large Rolodex which they'll be able to leverage. Or if we're talking about place itself, which is the exposure and the opportunity to expand the places and the ecosystems that Akida is. And really the best way that this is achieved is through agreements. But it's not just agreements with end customers, which of course is beneficial because it gets your product into the end products and obviously out into houses, vehicles, phones, into new locations around the world. But it's also through IP licensing agreements, which inherently expand the reach of Akida with new customer bases. If you think about mega chips, what do they do on the day-to-day basis? They put system-on-a-chips into products around the world for a range of customers. So they potentially will be able to expose a whole new customer base that might not have been familiar with Akida to the opportunities that Akida can present. And ultimately, they eventually will be the best ambassadors for Akida when you can see points of differences or competitive advantages that can be achieved by the new Akida technology. It's a fascinating marketing mix. We kept it simple today. We talked about the 4 Ps, but each of these really have been developed quite rapidly and accelerated just over the past 3 to 6 months. And they've signified this transition from Brainchip, moving from the R&D phase into this commercialization phase. Of course, with many conventional companies, they start small and they never have this real transition towards commercialization because they're always on and they're just incrementally adding on new customers and revenue as time goes on. But in some sectors of the market, like the biotech sector or like in the semiconductor space, you start off with a product that's not accruing revenue, you're actually developing it, you're investing heavily into it, but then over time as you transition into commercialization, you can see the hockey sticking effect start to pick up pace. And it will be fascinating to see where ASX BRN heads from here. If you did enjoy the video, don't forget to hit the like button. Feel free to share it out. If you're new here, welcome. We make daily videos each and every day, so make sure you've subscribed and turn your bell notifications on if you haven't yet. You'll be updated every time we drop a new video. Hope you did enjoy that video. As you know, I'm not a financial advisor. The stocks aren't buy recommendations. They're just a general discussion to be that starting spot for your own research. And I'd love to know your thoughts on them all as well. So drop in a comment below what's on your watch list for 2021 and what you thought of these 3 companies and where they do head. Thank you so much for joining us. For now, stay well and happy investing.